Let's do it. Perfect. Man, it's already February, which is cool in some ways. Like it's the month of love. For those of you who have a special someone, if not, you are your special someone. So take care of yourself this month. Started off kind of weird. We kind of ended January weird and started February weird. Those of us in the snowy, icy parts of the state, for whatever reason, we just get it once a year. But if you got shout outs, go ahead and pop your reaction button, put your hand up so that we can call on you. I'm going to hi May first. Yes, sir. Good morning.
Hey, good morning. So I just want to shout out an awesome member of our team, Esther Gomez. Big week for her. If y'all don't know, Esther joined our team, I think last April, and just her career has just completely taken off. Anyway, she was working, 40 hours a week at a flower shop as a general manager for a flower shop, and then yesterday was her first full-time day. She had quit that other job, and she is now in real estate full-time, and I just can't wait to see what she does, putting an extra 40 hours into the job, because she was putting 40 plus at this flower shop, and then now, here we are. So Esther, I just want to let you know we're also proud of you.
Yay, I love that, Esther. Welcome to full-time, girlfriend. That's awesome. So happy. Love that. Miss Helen, I'm going to you.
Good morning. Just wanted to shout out my team leader, Tracy. I had my first listing last week. I was going back and forth with the sellers because they were trying to list way too high. And she just gave me some great tools and verbiage, reports I could run from showing time, just supporting where they really needed to be if they wanted people to actually go see their house. And it worked out really well. We ended up having, I think, almost like 25 showings in a few days. So super grateful for her wisdom and everything that she gives us so that we can help people make the right decision.
Man, I love that. The difference between pricing right and, overpricing, right? 25 showings in a few days. That's amazing. Way to go to you for getting that listing appointment, and to Tracy for coaching you on it. You guys rock. I love that. I love that. Awesome. Awesome. I've got a couple shout outs. There's on our Austin team, Alexandra and Faith both had their 6-month come up. It some days feel so slow, and then you look back and it was so fast, right? Alexandra is our client success manager, and Faith is our administrative assistant, and 6 months went by like that. We didn't get to really celebrate that in office, but we at least get to shout them out this morning here. Man, just can't do things without our support system, right? And then Daniel Weiser in Austin took a listing. I know you all take listings, but I just like to highlight the ones that are kind of like those lead gen levers that we don't love to do sometimes. $670,000 from withdrawn listings. And then Memo, pending a 305 from a sign call, right? So get those listings, because you just never know where your next deal is coming from. It could be a listing lead from that listing. It could be a sign call. Pick up that phone, get that listing. I love it. Brandon, I'm going to you.
What's up? Want to share some gratitude and give a shout out to Matt Bowles, our operations coordinator. Yesterday was his first year on our team, and a lot could happen in a year, and a lot did happen because of Matt. So we appreciate him. And then shout out to Alicia. She got to help her parents kind of relocate and buy a new house. I believe they closed on Monday or Tuesday. So shout out to her for that, for helping out her family.
Oh my gosh. First of all, Matt, awesome. You rock. Can't wait to hopefully see you soon. And then, man, love seeing dreams come true for Alicia and Andrew's family. That's awesome. And that's been on the list for a long time. That's so cool. So cool. Sweet, man, we have a lot going on. So today, if you're just now popping on, or you didn't read the calendar invite, today we're talking about creative financing options. It's going to be very power packed. I have listened to Emily do this presentation, and it is a lot of information. So here's what I recommend. I recommend however you take notes, whether it's on your phone, whether you just pop open something on your computer, or maybe you're a note taker and you just use, you know, pen and paper. Totally cool. The best way to maximize this morning is definitely going to be to take notes. You'll learn it and you'll remember it so much better that way. One thing I want to say about creative financing, because you use the word creative financing and you have a very, very polarizing response, right? Sometimes it gets a bad rap, right? Like we all know like weird people out there who do weird creative stuff, and we're like, yeah, that's not who we are. We don't like that. I can tell you, Emily is one of the classiest people. I don't know that I know many more people that are classier than her. So definitely keep your mind open that creative financing does not have to be this weird thing that weird people do. It can be an absolute great tool in your tool belt, especially as the rates have climbed higher compared to the last 2 years, right? And then I'm going to go ahead and I'm going to spotlight Miss Emily and make her a co-host. But while I do that, I've known Emily probably like maybe a decade now. It's been a very long time. Again, seems short, but then you know what? Here you are. A decade later, we are just as cute as we were 10 years ago, I promise, guys. And Emily, you're in Arizona. What part of Arizona do you serve?
Yep. So I live in Scottsdale, and I have a team here, and we service the whole Phoenix Valley.
Okay, so if you happen to have gone to Built How before last year, maybe, that's the area she's in. And she's got the cutest, best looking team ever, which is really cool. And you guys sell a lot of property out there. So it's really nice. So Emily is somebody who, not only is she a great businesswoman, you guys, she's a mom. So if you're a mom on this call, or you know a mom, or you have a mom, you will probably like Emily. And she's worked really hard on her own personal wealth building. So this isn't something like Emily didn't just take a quick class and was like, oh, now I'm going to teach it. You know, this is Emily's life. This is like the last, I don't know, decade of her life that she's teaching us today. So I'm excited. Emily, I'm going to turn it over to you and just like let you take control.
Thank you. Well, I appreciate you guys having me. This is something I really love talking about, and Adelina is definitely right. Sometimes thinking about things in a new way and a more creative way that's different from how we've been traditionally doing business can sometimes feel a little bit overwhelming and scary. And I'm kind of hoping just to maybe challenge your thinking on some things to not only help you do more deals for your clients, but also maybe think about things in a way to help you, maybe add to your own personal portfolio if you have goals of building a real estate portfolio. So let me go ahead and share my screen. And I'm working on a laptop, so bear with me.
Oh, you're doing great. You have more makeup on than most of Texas this morning. We're still trying to battle our way through the cold, and you are all prepared. We're ready. Love
Awesome. So I tend to not be able to see the chat when I'm going through the presentation. So please just feel free to stop me if there's any questions that come up. And we'll kind of go through this. So, and I will make sure that Adelina has a copy of this after, and I'm definitely open for any questions that you might have. So let's get into it. So we're going to talk through some creative financing types today. I'm going to tell you a little bit about my history and just challenge you on why you should be thinking about creative financing, both in your business and as a way to add to your portfolio. So there's a little bit about me. I have flipped over 150 properties, both for myself and for some clients. I've bought and sold almost 100 homes for myself. We started using creative financing in our clients' deals all the way back in 2010, just as a way for us to close more deals. It took me a while to realize that I could do that for myself and buy properties. And it's the primary way that I've built my own personal real estate portfolio. So just a quick disclaimer, I'm in Phoenix, I'm in Arizona. The deals that I do are primarily in Arizona. I have worked with an attorney on everything that we have done in the past. I am not aware if there are any specific laws or rules in Texas that would preclude you from using some of these tactics. And so I always just do a disclaimer of wherever you do business, there will be an attorney that you can run this by, just to make sure that, what's required in your state, disclosure forms, things like that. Okay, so why would we use creative financing? So why we learned about it in the first place was a way to create solutions for our clients. Markets change. We've had an amazing market the last few years. If you're newer to the business, then this is all that you've known is the last few years. It doesn't always look as pretty as it has the last few years. And things get challenging. And we were faced with a time, years that passed where we had a lot of listings that weren't moving. So we were kind of forced to think about things in a different way, and creating something that was a little bit more creative outside of the box helped our sellers move homes that maybe weren't moving previously. And also we were creating homeowners in a market where maybe buyers' personal situation may not ordinarily allow them to buy a home. Maybe they have a credit issue, maybe they had a bankruptcy, they have money, they have a down payment, and we were able to kind of play matchmaker and put them in homes that maybe a traditional lender said no. Adding to your own personal portfolio. We have such an opportunity in our business to get the lead on a hot deal coming down the pipe. I just spent a morning at Goldman Sachs last week when I was in New York for Inman. And, if you get in, and he specifically talked about having some inside information when things come through on businesses. And, if you act on stuff when you're in Goldman Sachs, insider trading, you can go to jail. If we get a hot deal in real estate that comes across our desk, we can buy it at a discount. And there's no issues with that at all. So take advantage of that. We have just such an opportunity to be the first ones to see some of this stuff. Acquiring properties for low percent down. I have bought a home for $1,000 before. Almost every home that I have bought to add to my personal portfolio, I have paid much less than 20% down. And I don't know about you, but this was the number one reason why it took me so long to invest in real estate, is because I just did not know that I could buy a property for less than 20% down as an investor. And I just didn't have the money to buy multiple properties and have, the down payment to put all of that down. So I definitely want to challenge your thinking on that, because I've bought many, many properties for significantly less than 20% down. Avoiding Fannie and Freddie loan limits. I don't know if most of you are aware, but as someone who has a loan, you can only have up to 10 loans in your name under Fannie Freddie guidelines. So as you're building a portfolio, there will become a time where you would like to have more than 10 properties, hopefully some of you. There are no maximum number of properties that you can purchase through some of these strategies. And there are no loan limits. And then build wealth and save money. This is my favorite thing to talk about. We have such an opportunity to build massive wealth and a massive, legacy for our family's future through, investing in real estate. In addition to just some of the amazing tax benefits that we can take advantage of. I shared with a group that I'm in with Adelina. I was able to get my own personal tax bill down to, in essence, less than $1,000 last year, because of investing in the amount of properties that we did and taking advantage of some of these strategies to, save on our taxes. So just a few of my favorite reasons. Do I have any questions before we get going?
Not in the chat so far, so good.
Okay, cool. Okay, so let's talk about some financing types. So, this is probably the one that you've all heard of, an assumable loan. Have you guys heard that term before? And are you guys aware that, these are kind of coming back, making a comeback? Okay. So this is probably the one that is most common, and people know about. So what is an assumable loan? Basically, FHA and VA loans have a clause in them that state that you can assume that loan. So if I'm a seller and I go to sell my home, I could potentially have another buyer take over my loan through the lender. So that means that they could take over the loan at the terms that are there, the rate that is there, and why would that be appealing? Because rates have gone up significantly, and people that have purchased in years past have very attractive rates. And if someone has a large down payment, and can qualify through a traditional lender, this is a great option. So what are the downsides to this? You must go through the lender to qualify. So if you have somebody who doesn't necessarily qualify traditionally, this may not be a great option because you do have to go through a traditional approval process. We are going through some right now, and I will say that the timeline is very long. We are running 90 days on one we're doing right now, and some people just don't want to wait that long. So it's definitely a much longer timeline than some of the other things that we'll discuss, and also just a traditional loan as well. So it is subject to lender requirements for the assumption. And if your seller does have a VA loan and they do sell it via having someone assume it, they will not be able to use their VA benefit again on the next purchase. So that is something to think about. Do you have a question?
I do, just so that it makes sense. Or I don't know if you have it on the next slide, just in case you don't. If somebody has, let's say, a $200,000 loan at like 3%, and now their house is worth 300 and they want 300, are you making up the difference?
Yes. So in this scenario, many times the seller is going to want to get all of their equity. So the scenario we have right now is we have a listing, it's around 500,000. It has a VA loan on it at around 2.75%. They have about $200,000 of equity, which normally is pretty high. Most people don't have a 40% down payment. Well, we just happen to have somebody who approached us who has a 50% down payment, basically, and can qualify for the VA assumption. Our sellers will get enough out of this property that they don't need their VA benefit on the next purchase. And so it's kind of a win-win. So this guy can assume the loan, take over the low interest rate. Our sellers can get all of their equity out of the property, and they can move on and buy a loan through a different conventional program because they have quite a large down payment.
So essentially, this is really valuable for somebody who says, they want to have that, 3% rate again. Like this might be your only shot of ever getting.
Yep. The downside to a traditional assumable is conventional loans do not have an assumable cost. So it's really FHA and VA only. It's typically only for owner occupied. So this could be a great option. And this is something that is easier for your sellers to understand because they do go through a traditional loan process and their name is removed from the loan. So sellers seem to really understand this. However, if you do have a buyer who, again, is outside of that kind of traditional vanilla lending box, this may not work for them because they may not be able to get traditionally approved.
There's a question in the chat box. If a buyer has their own VA loan, can the seller then take their VA loan with them? No, it's assuming the loan that is in place. So if the buyer were to put their new VA benefit on there, it would be a new loan. So that the scenario would not work. Copy that. Yep. Okay. Move on. All right. So now we're going to get into some that are maybe a little less known, than assumable. So the first one that I want to go through is called a seller cary. So you may have heard it as a carryback, a seller cary. And basically what happens in this scenario is this occurs when the seller acts as the lender or bank and carries the mortgage of the home in question. So if you were purchasing a home, and in a traditional seller cary, there traditionally is not an existing mortgage. So if you have somebody who owns a home free and clear, but they are willing to, potentially carry a loan on that property, this could be a great option for them. So the seller is really the one who kind of sets the terms. They are negotiable, but because there isn't a loan in there, there's not a traditional, qualifying. You don't have to go through Fannie or Freddie guidelines. It's really a buyer and a seller coming up with terms on what will work. So the down payment and interest rate is by agreement. There are no loan limits.
There are no requirements on whether you purchase this as a primary or a second home or an investment property. And why would something like this be appealing to a seller? So, if you have a seller, particularly somebody who's older, and they have a paid off home, sometimes the idea of taking that money and knowing what to do with it, they're not sure. They may not need it for something, but having a monthly amount that comes to them every month, it's almost like you're presenting them an investment opportunity. They're getting a monthly amount every month. And the idea of just getting that check every month at a rate that is attractive to them could be a really great solution, not only for your buyer to get into a property, but to be able to have that seller have just some income every month, that could be appealing. So I'll give you an example on the next page. So for an example, a seller owns a home on Main Street. There's no mortgage on the home, but the current value is $200,000. The buyer would like to purchase that home and has a large down payment, but may already have 10 loans in her name or can't qualify for a loan for some reason. So the buyer presents purchasing the home at $205,000, puts down $40,000, can close in 7 days. And the seller will give her a loan for $165,000 in the form of a seller carryback for 5 years, amortized for 30 years at 7%. So the seller is going to get a 7% on the money that she's lending. You can see in this scenario, the buyer paid slightly above what the market value is. And the rate, in this scenario, when I did this slide deck, was slightly higher than market. And, depending on the day, rates have, vacillated. But the way that they would set this up is that the buyer would pay a third-party servicer. So oftentimes your title or escrow company has a servicing department, not unlike Wells Fargo or Bank of America. The buyer pays that servicing department, and then the seller is remitted payment every month on a monthly basis. So in this scenario, we have a 5-year agreement. It's amortized over 30. So like a traditional 30-year mortgage, what you're all used to, but after 5 years, that loan will be called due. So what will happen at the end of that 5 years is the buyer can sell the property, they can refinance the property. The seller then is paid their full amount of what they're owed. The buyer still retains the property, and the agreement's done after 5 years. Any questions on that?
Emily, I have a question.
Yeah.
If it goes to a third-party servicer, will this show up on the buyer's credit in any way by using a third-party servicer like that?
Oftentimes, no.
Okay.
Yeah.
The first deal that I ever sold in Austin, the buyer was pretty wealthy, and they were using seller financing to buy the home for their son, and they approached us and on the sell side with it. And when I asked why, they said they didn't want it. They were about to do this business deal and they didn't want it showing up on their credit.
Yeah. So, none of these, I have quite a few properties that don't show up on my credit. So in terms of going to get other financing for things, it is a benefit. Now, I will say, when you go to get traditional financing for something, because some of these properties will show up on your tax returns at some point, there is some explanation of things that happen, but in terms of a credit liability on a traditional credit report, doesn't show up.
Thank you.
Yeah. Okay. So now we move into a new topic. So this is called a subject to financing. So how I would define subject to is when a buyer takes the right to the title of a property, subject to any underlying mortgages or liens. So the new buyer commits to making the payment direct to the seller's lender. The loan's taken over, but it is not assumed in the traditional sense. So in this scenario, when I've purchased a property subject to, I am not assuming the loan. I am taking over the payments. I am taking over responsibility of the loan, but I am not specifically notifying the lender that I'm taking over that loan. The current amortization conveys. So let's say I purchase a property and they're 5 years into a 30-year amortization. I take it over exactly what the current payments and current amortization structure would be. you can close very quickly on this. You know, really, as soon as we pull title, we can close within a few days. It's very, you know, a simple closing and doesn't take a traditional mortgage process, you know, qualifying process. So why would someone be interested in selling a property or buying a property subject to? So a lot of the properties that we have purchased that have been through this means a lot of times the seller is in a distressed situation, right? So I'm going to share an example on the next page, but we have purchased some properties that maybe have been in default, are getting close to foreclosure. You know, the seller, you know, particularly at a certain point when we were buying these, you know, in 2018, 19, the market hadn't corrected to the point where they had a lot of equity. So it wasn't that they were giving up a lot of equity. A lot of times we've worked out things where we've brought the mortgage current, we buy the property, we give them some time to lease back in it, you know, before we kind of have them move on. So I'll give you an example when we purchased on this next page. Okay, so this is a home I own. It's here in Scottsdale. And we found this on a default list. The owner was about 7 days away from foreclosure. And this was in the fall of 2018. So we purchased the home subject to the existing liens. Sorry, my dogs are going to bark for a sec. So the existing liens were the following on here. So the first mortgage and a second mortgage. The total liens on this property were right around $440,000. In this scenario, we did allow the seller to lease back for a period of time so he could kind of get his bearings and figure out where he was going to go next. Once he moved out, we did have a pretty high renovation cost on this property, which was right around $125,000. So we were all into this property about $565,000. But the current value on that today is $800,000. And my monthly costs on this with the two mortgages that I have existing are about $2,800. And we have a rental income of about $4,000 a month. So I still own this property. It is rented. And, you know, we took over the existing lien, make the payments direct to the mortgage holder. And if and when we ever decide to sell the property, our agreement with the seller is done. We do not have any future agreement with him. We can pay off the existing liens. We would be able to keep the excess, you know, and our agreement with him ends the day that we close on the property. So for him, you know, the benefit to him was he was about to go to foreclosure. He did not have any equity in this property. And, you know, he was in a position where in 7 days, he was going to have to figure out where he was going. So the benefit to us is we knew that putting in some renovation on this, that we could have some sweat equity on the property. It was a property that would rent well. It was in a great location. There would be some good appreciation. And in this scenario, we, you know, probably overspent in terms of what we would want to do renovation wise on the property. But I knew that I could refinance it and pull a lot of my cash out and still retain it as an asset. So it still made sense for my personal portfolio. Any questions on that?
We're trying to figure it out if it's legal in Texas.
Yeah, we looked into it and talked to a lender and they said that in Texas loans, you cannot do that for Texas. And Adelina was asking if there's a workaround. I mean, sure, you can just do it and hope they don't find out. But like Jen was saying, they could call the note due. And secondly, you with having your real estate license is a bigger issue if it were to get caught. But yeah, so we looked into this after we had our webinar with you, and the loans in Texas say that you can't assign it. You can't have somebody else take over.
So that is true for all loans. There is a due on sale clause. And so that definitely is a risk for all loans. And I don't know that that's Texas specific. So this is, so yes, that is a risk to both your seller and you should you call the note, should the note be called due. So what we have in our purchase agreement, and so you may want to just maybe run this by an attorney. So it basically says if that were to happen, that we would refinance the property within a 30 or 45 day period. We do disclose on all of our documents that we are licensed. So yes, the disclosure piece is very, very important. So when a lender calls a note due, they have to report that note on their books as non-performing, even if it currently is being paid and all of those things. And that changes the lender's liquidity requirements and also just their books in terms of having non-performing assets on there. And so we have not had that happen here where notes have been called due, particularly on lenders that are larger. But, you know, again, I definitely want you guys to do the research and make sure that there's something that, you know, could happen there. But that's how we've got to work around here, is having something in our agreement saying, if that were to happen, yeah, we will go figure it out and we will refinance that property. Go ahead. Is there a question?
Yeah, how is title held in these situations? Is that transferred up front?
It is, yeah. Yep,
Okay.
so it closes, we use a title company. My name's on the deed. I use a third-party authorization from the seller to have access to his online mortgage. We pay the mortgage company direct. And yeah, so my name's on the deed. So certainly if the lender were to pull it, they would see, we put it in an LLC. So on my own primary home, I could put it in an LLC and I wouldn't have necessarily changed the title on it. It would still be me. So a lot of times, I mean, we've never had it, even a lender question it, but it definitely is something that could happen.
Okay, and are you doing different LLCs for each property, or are you up to a certain amount for one and then moving them over?
I am not. I know that that's been the advice on some. My taxes are complicated enough and I try and maybe not overcomplicate them, but I know that that is the advice from some people. And I would say, I am not an accountant, and talk to your accountant.
Thank you.
Yeah.
Will you say again how you're able to actually pay the note? Because I know we had a client where they were getting behind, and his wife, because she wasn't on the loan, they wouldn't even accept payment from her. So I'm just curious how you're actually able to pay that.
That's interesting. I wonder if she was calling to try and get information and they're saying we can't talk to you. We have the seller complete a third-party authorization. I mean, this may be long before most of your time, but we used to have things called short sales where, you know, basically there wasn't enough equity in the property and we were negotiating direct with the bank. And so all banks have a form that's called a third-party authorization. A lot of times they'll want the seller to notarize it. And it just basically says that they're going to give me permission to call the lender to speak about the loan on their behalf. On most of these, I have gotten direct login information for their lender, and I just set up auto payments direct on their lender's website from my account to the lender. So that's how we've gotten around it. And we do have them fill out that third-party authorization. So there's definitely no confusion with the seller that we're going to be calling the lender to talk on their behalf. Okay.
Oh, last question. Sorry on that.
Yeah.
Patricia had asked, does the seller carry the note on their credit and DTI?
Yeah, so the loan will still show up on their credit. And here's what will happen when they go to, you know, if they want to go buy another property, you'll have a purchase agreement, you'll have a settlement statement, you'll show that it's closed. I can show on the ones we've purchased that all of those payments have come from my bank account. And so a lot of times with them going to purchase a new property, providing all that document to their new lender, the DTI should not be counted against them because it is closed. It's kind of like you know, like if they were to rent the property, they have, you know, money that's coming in to offset that. And I can show that I've closed on it, I own it, that they're basically just a lender. Yeah. Okay. Moving on. Okay, so a wrap. This is another thing that is similar to a subject to, but it varies in a couple of ways. So sometimes you might hear this as a wraparound. Some people refer to it as like a sandwich. There's, you know, a variety of ways people describe it. But in a wrap scenario, a seller's original loan will stay in place. The buyer will sign a new mortgage with the seller that then wraps around the existing mortgage. So the new terms of this can wrap the existing loan exactly, meaning I can take over the amortization and current schedule at the exact price. and terms, or potentially I negotiate something with the seller where they have a really low rate. Maybe they have a 2.5% rate, and my buyer would be interested in paying 5%, and the seller, which is still lower than what they could get, through a traditional way. And the seller can collect the arbitrage on that, the difference on what their existing rate is versus what they're able to wrap it at. So in this case, when we have a difference in that, the buyer will make their payment kind of with a third-party servicer, similar to what we described earlier. We use just a title company that has a servicing department. If they purchase a property for more than what it is on the existing lien, a portion of that will go to pay the existing lien, and then the delta will go to the seller. In a wrap, we can close very, very quickly, similar to some of these other strategies, and no traditional pre-qualifying. So let me give you an example of one that we purchased. So this is a home that I own. It's in Fountain Hills, Arizona. It's just the next city over from Scottsdale. This was a listing that I had for an entire year back in 2018. So the sellers had a VA loan on this property, and they had already pulled out all of their equity on the property. So because they had done that, even though they had just pulled out a couple $100,000, they would not lower the price, because they were like, well, we don't want to bring any money to the table. Even though they'd already gotten all of their money out of the property, they just would refuse to drop the price. So we were about to lose the listing, and I just was thinking, like, is there anything that we can do here that, could be a win-win for everybody? So they were elderly. This is a big house. It's got lots of stairs. They needed to move to Florida. Keeping this house is just, not a feasible option for him. So when I calculated after closing costs and commissions, they only had about $10,000 of equity in the property. This property was originally listed for right around $900,000. So, and they had an existing 3.25% mortgage, and they were open to coming up with a creative solution on this. So I purchased the property. I gave them their $10,000 of equity at closing. And they had some furniture that they did not want to move. And so I overpaid for about $10,000 worth of furniture. So they got about $20,000 at close. And I basically did a wrap and took around this existing lien. So I still own this property. I closed in January 2019. It's been an Airbnb for me. It makes about $100,000 to $120,000 gross a year. And cash flow is about $40,000 to $50,000 a year. I have about $850,000 of equity in this property. And I make about $50,000 a year, all from a $20,000 investment. So I just did refinance this property because my agreement with them was only for a couple of years. They would not do an extended carry on this, but this is one that was pretty much a slam dunk. So they were thrilled because they could move. They didn't have to make any repairs. They didn't have to come to the table with anything. Yes, their VA loan stayed in place on this property. And that was the one thing that they had to, figure out, is when they went to go buy another property, they weren't able to use that VA benefit again. But to them, figuring out that other piece was worth not having to give up some of the money that they'd already pulled out of this property. Any questions?
I have another question.
Sure.
So by the time, so for the seller carry, the wraps, and things that have a balloon on them, like the one you just mentioned, are you using lenders who will then just qualify you based off the performance of the investment?
Yes and yes and no. I'm guessing maybe you're referring to like a DSCR loan, which is a debt service coverage ratio. It's basically, if you own an investment property, you can go get this DSCR loan, which is based on just the income of the property. That is available. I've looked into it. The rate is a little higher than I like, and it didn't, the cash flow wasn't as great with that DSCR. So on this one I did, I actually went with an ARM product because I could find something on this where I could do a cash out refi on a jumbo, and I'm in the 5. So it's not amazing, but it's also much better than, other traditional financing stuff. And the DSCR was like in the 8% range, and I just wasn't willing to do that.
Thank you.
Yeah.
Hey, Emily, I've got a question.
Yeah.
So what would you say the main difference between like an assumable loan and a wrap would be? I don't know, I guess I'm getting them confused a little bit.
Sure. So on an assumable, you have to go through an approval process with the lender. So even if you don't have a VA benefit and you wouldn't normally qualify for a VA loan because, you know, I'm not eligible for that benefit. I can still go through an assumable process to take over that VA loan. In a wrap scenario, I'm only working it out with the seller. The lender was never notified that we took over the loan. And on this particular property, this seller she's elderly, and she was nervous about this, right? She wanted to make sure it was going to work out. So I actually never got login information on their loan. I gave her a voided check, and she set up auto payments. I wasn't comfortable making the payments to her because then I need to make sure she makes the payments on the mortgage. But basically I was comfortable giving her a voided check and making sure that those payments got made direct to the lender. So the title still had my name on it. The payments came from me. You know, we had this for about 4 years. The lender never even questioned it or had any issue with the payments coming direct from me. But I did not notify them or get their permission to assume or take over the loan. The loan still was in her and her husband's name. Okay. And then this is just another strategy that, you know, as you guys are out there looking, you know, if you see a property that, you know, you have clients that want to sell, or you see something that is a great deal, I want to challenge you to look at it potentially for your own portfolio. And this strategy is a really great way to, you know, recycle your cash. Meaning when I do the BRRRR method on a property that I intend to keep, I'm able to use my cash, and because of the value add that I add to the property, I refinance and pull a lot of my cash back out, so I can use that same cash for another property, but I can still retain the asset. So for those of you that don't know what this is known as the buy, renovate, rent, refinance, and repeat. And it's just a great way for you to recycle your cash on multiple deals. Typically with this strategy, I will purchase with cash or hard money. Hard money, for those of you who don't know what that is you probably have lenders locally who will lend you money for a short period of time, typically at a higher interest rate than what you'd be looking at for a traditional loan. But they can get you money fast, typically in a couple of days without, you know, qualifying, you know, financials. They'll just want to know what the deal looks like, what the property looks like, you know, and what your intention is with it. So, and then with these, I'll refinance through a Fannie Freddie program and try and pull some of my cash back out. So this is a property that we purchased. You can see it's quite beautiful, 1968 special, and in a really great part of Scottsdale. And I knew that there was, you know, a lot of upside on the renovation. So we gutted it. We added some square footage, added a bedroom, you know, completely gutted this property, you know, and with the numbers on this one, we bought it for $480,000. We got a $5,000 concession. This one did cost me quite a bit in renovations. We had about $142,000 in renovations. And I do not like to part with that much money on one single property. So this one only made sense for me if I could refinance and pull a lot of my cash back out. So in this scenario, when we were done with the property, I had about $627,000 into it on my total cost. It appraised that day that we refinanced at 800, but the current value, that was about 2 years ago, the current value is at around 1.1 million. I was able to refinance and pull almost all of my cash back out. I left about 75,000 in the property. And that was only because the loan amount then was 548,000. If the conventional loan amount had been raised, I could have pulled all my cash back out. But at the time I refinanced this, my payment, I still have this home. It's at a 3.5% interest rate. I have a tenant in there paying $5,000 a month. And so I make about $2,000 a month, even after all my costs, on a $75,000 investment that I left in there, and I retain the asset. So I know you guys have some of these coming across your desk, and I would challenge you, before you start taking these to your investors, are some of these ones that you could close on and keep in your portfolio. You know, and if you come across something like this and you're not sure where the money is, trust me, you can find the money when you have a really great deal like this.
To get that 3.5, did you buy down the rate, or was it just
No.
that was?
That's just how good it was back then. Yeah. Okay, so other things to consider, like we talked about, different states are going to have different regulations. Please do your due diligence. I would also go and speak with an attorney. Like, you know, yes, you do have due on sale clauses on some of these mortgages, on a lot of them. Yes, there are some risks to some of this. And if you have things structured in a way to help you mitigate that, I would say some of these are still possible, and maybe not all in your state, but there definitely is something here that you could take out and use both in your business and to add to your personal portfolio. And I would just, you know, I would talk to somebody about that, right? I had somebody say, well, my attorney told me I shouldn't do a 1031 exchange because, you know, it's a red flag to the IRS. You need a new attorney, right? Like, you know, that is not true. You will want to talk to somebody who really understands, and understands how to accomplish some of these. Not somebody maybe who immediately say, well, no, you can't do that, and here's why. We certainly don't want to do anything that is not allowed in our state, but a lot of times there is a way to accomplish some of these things, you know, and you would just want to make sure it's structured in a way that you're following all the regulations. If you're adding to your portfolio, each property needs to stand on their own. Do not make a bad deal because you have a desire to add properties to your portfolio. And I just want to challenge you that, you know, these are really great things that you can do to help not only your clients, but think about things with an investor hat on too. And just buying a couple of properties over the course of time really can help you with your financial future. And to me, that's, you know, some of the best benefit for us being in this business. So yeah, and that's all I got. Open up for any questions.
Jen has a great question in the chat. She said, do you ever buy down the rate when you know that you're going to use it long term?
I absolutely would, because most of the stuff that I've bought creatively. We tend to want to go after stuff that already has good rates in place. But if I came across like a killer deal that I wanted to buy, I would certainly think about buying down the rate. Yeah. Most of these we haven't refinanced because they've already had stuff in place. So we just haven't gotten there. The ones that we did at the time, you know, we just happened to get lucky, and, you know, the investor rates were in the 3s then. We haven't, I haven't gone through a traditional purchasing process with today's rates. I'm trying to go for stuff that still has a good rate on it.
When you do get a hard money loan, like what are the typical, like what are you seeing is typical as far as some of their requirements or some of the terms of it?
Sure. So my hard money lender wants a purchase contract. They want to know if my intention is to renovate the property or just refinance. And they want to know what my renovation budget is. They typically pull their own comps. They do not ask us for any financial documents. Typically the lender that we work with takes what we're purchasing the property for, their own comps, what we're planning to do to it, and then they go to their underwriters and come back with terms, right? So depending on the purchase price, it could be anywhere from 10 to 20% down. Depending on the project, sometimes they will finance the renovation within that. Sometimes they won't. So I would say you probably should shop a couple lenders. We tend to go to one just because they are really easy to deal with, and we can get an answer next day. We could get money within a couple of days. And yeah, the rate is not pretty. It's definitely over 10%. But I have no intention of keeping the loans on this property. And sometimes when you come across a deal and need to close fast, paying 10% for 90 days, you know, on a short loan is worth being able to close on something quickly. And in that scenario, when I go to refinance, then, you know, particularly if the numbers make sense, I may buy the rate down, you know, on some of those.
And then can you share, you know, where were you 5 years ago or 10 years ago? Like, were you always like this good? Like, kind of where did you build from and where are you now? Like, give us kind
Yeah.
of like a inspiration or a vision of perhaps
Sure.
where we could be.
Yeah. So I use these strategies to help my clients for almost 10 years without buying a single property myself, because I was scared to, I'm in Phoenix and I've been doing this almost 20 years. So when the market crashed, I mean, I was at the center, all the time. I should have been buying properties when they were the cheapest and the rate, you know, I didn't have the money. I didn't understand how to do this creatively. And so it kind of prevented me from getting into the market because I felt like if I didn't have 20% down, I couldn't buy something. And if I had to come up with 20% down on every property that I wanted to buy, I couldn't scale quickly enough. So it really prevented me from getting in the market myself, even though I was putting amazing deals together for other people. It just didn't click for me that I could do that for myself. So when I started to figure out that this was a solution and we were really providing an amazing solution for our clients that didn't have another option, right? Like, you know, the first purchase, the home that I purchased was a repeat client I have. She's a single mom. She has 4 kids. She wanted to buy a new property and she was under contract on a new build and her property did not sell. She was faced with the choice of walking away from a $5,000 earnest deposit on her new dream home, or we got an offer on her property where she would have had to come to the table with $5,000 in order to get it closed. And she just didn't have that kind of money to lose. And so I was able to buy her departing residence for very, very low out of pocket, a property that I still own today. I have over $200,000 of equity in that property now from a very, very small investment. And to her, I created this solution where she got into her dream house. She didn't have to come up with this extra money to get out of her old house. I mean, she's referred everybody she knows to our team. So it's, you know, and once I realized that it was like, I thought, oh, this is amazing for me, but it's also amazing for these clients. Like once you start opening your eyes to that, I guarantee these deals are going to just fall on your plate. So we kind of went on a buying spree at that point. And I had a business partner. We have had as many as 40 single family homes at one time. You know, and then what I've done over the last couple of years is maybe sell some ones that aren't cash flowing as high as I want. I own less homes now that are at a higher price with higher cash flow. You know, and I'm really able to figure out how to, you know, push my cash flow from my rental properties to sort of help offset, you know, what I make in my real job in case I decide I don't want to sell houses forever.
If we want to get in touch with you after this at any point, or, you know, you never know, 5 months from now, you see an opportunity. How do we get in touch with you?
I'll get you the slide deck and my contact info is on the last page. And I'm happy, you know, for you guys to reach out with any questions and happy to be a resource for you.
Love that. Joseph, you have a question.
Yeah, I guess the first question is where did you start learning about this? And second question would be, I know you're a great resource. What other resources would you look if, say, you really wanted to dive deeper into any of these strategies, I guess?
Yeah. So for me, when I first started putting these together, we did reach out to an attorney to help us craft some documents because we wanted to make sure that like I am licensed and you know, just the disclosure piece is very important. And you want to make sure that, you know, everybody understands what's happening in the transaction. So, I went to quite a few classes on it. There's some attorneys here that do classes on it, some title companies that do classes on it. And so there probably is some resources where you're at that maybe, you just haven't seen. And so I would dig into that first and make sure you have your documents and forms that somebody's looked over to make sure, you know, that you've got all your I's dotted and T's crossed. And then really it's kind of every deal that I've done has been different in some way. And so it is a learning process through each one on how do you create the win for the client? How do you structure things? You know, I just had a call with somebody last week who said, hey, I have one that this could be a potential. Well, we decided after that call that it wasn't one that she was going to move forward on because of some various things. So some of these could come across your desk that seem great on paper. And once you do some due diligence on them, you actually pass on the deal.
I love that. Brandon, did you still have a question?
Yeah, I was just wondering, Emily, because sometimes, you know, it sounds like you're really good at seeing an option and then filtering it through possibilities, right? So
Yeah.
like, do you happen to have like a cheat sheet or something you're using for your agents that would help us think faster when it comes to these resources, like low equity, go here first, and then run it through maybe low interest rate, high equity, go here. Do you have something like that that would kind of help us think faster?
I don't. That's a really great idea, though. No, I don't have. I haven't made anything like that, but that's a really good idea, and I definitely probably could put something like that together. But I would say, you know, as you're talking to your sellers, do you have a seller that's been sitting a while that you think you're probably going to lose the listing? And have you thought about, is there another way, right? Because we always think like, our client will only sell if they get this price, they get every amount of bit of their equity out of their house. And a lot of times, like, that may not be the case. You know, the market's not going to be tough like this forever. You know, it always changes. So do you have a seller right now that you might be losing the listing on, that either you could buy the property, or could you come up with, you know, an idea for them that could help them get out of that property in a way that they haven't thought about?
Thank you.
Yeah.
Emily, you are awesome. And to everyone listening in or listening to the recording in the future, I think what sets Emily apart, just from being her friend for so long and just seeing how she does businesses, the reason I think a lot of creative financing or wholesaling or all of this, like those words that you hear out there, gets a bad rap, is because they put themselves first, right? I think what Emily has done and has strived to do is put the client first. And then the byproduct is, if it's a win for her, she'll do a deal, right? It's got to be a win for both parties, not just for Emily, right?
Yes.
So that's how you keep it classy. That's how you keep it with integrity. That's how you build like something worth having. Like, we all know a lot of people who do creative financing and they had one good deal and then they can't pay their taxes. You don't see them again for like years, things like that. Like, that's not sustainable. That's just like, that's like wannabe stuff, right? Like, this is the way to do it sustainably with class, where everybody wins in the end, right? So
yes, and there's a way to do it that, yes, maybe it's a win for you, but if you know, it could be a win for them. You disclose it. You can do this while licensed. Like, there's a way to do this where it is a win for everybody. And if it isn't, like, yeah, we're just not interested in going down that path. It's really to create a solution for them. You know, and you win on it too.
I love that.
Emily,
Go ahead.
do you leave the same insurance and everything in place then too?
So no, I get new insurance on everything, and my insurance provider will just do like what you would do on your primary. They'll just bill it through the carrier.
Got it. Wow, we learned a lot today, Emily. Thank you for your time,
No problem.
especially after coming back from Inman. I know you had all this extra time available today. Really grateful though that you did take the time for our Texas group here. And you'll see more of Emily. I don't know, are you going to Bill Howe or no?
I'll be there. Yeah.
Okay, so yeah, if you ever want to meet Emily in person, she will be at Bill Howe in Palm Springs the 3rd week of March. We will see you guys next week. Stay warm, stay safe, and maybe get some deals while we do all this. Thank you, Emily, and we'll see you next time, Texas.
Thank you.